Let's do a quick check of the markets now, sponsored by Tasty Trade. As we see, oh, look at that. All three major averages are in the green right now. The Dow, the S&P, and the Nasdaq have all flipped to green. That could change, of course, as the day goes on. But we have seen a lot of money flowing into defensive sectors as well as other assets that are viewed more defensively, as we were just discussing, places like gold here. So it looks like this is not coming because investors are judging that the coast is clear, but rather that they are trying to position themselves defensively. Well, as the largest bank failure since the 2008 financial crisis sends shockwaves through Wall Street, concerns for what the collapse of Silicon Valley Bank means for the banking system are making the rounds. Here to take a deeper dive into the threat of the safety and soundness of the financial system is Bethany McLean, Vanity Fair contributing editor. Bethany, it's been a while since we have talked because you, of course, are known quite well for your examination of the Enron collapse and then the financial crisis as well. And so we wanted to talk to you about your perspective here, given that this has echoes of that period in time, but also some big differences. So what's your kind of big picture view of what's going on right now?
Well, my big picture view is that the 2010 Dodd-Frank legislation was supposed to prevent this sort of thing from happening again. And I do think this is a massive regulatory failure. And I think that there should be an examination of that. There were all sorts of things that were put in place that were supposed to ensure that we weren't in this situation again. And here we are.
Bethany, what changed? Was it the Trump administration that changed certain regulations that you think ultimately caused this?
Well, they did weaken some of the Dodd-Frank strictures surrounding smaller banks like Silicon Valley. But I think the bigger problem is that a decade plus of easy monetary policy led to some risks in the banking system that for sure seem obvious in retrospect. So maybe this isn't 100% fair, but they seem like they should have been obvious at the time too. And yet regulators didn't catch this. And this is not a bailout of Silicon Valley Bank, but it is a bailout of the depositors. And the question as to whether that should take place, I think, is a legitimate one. These venture capitalists and their portfolio companies were getting a lot of favors, in a sense, from Silicon Valley Bank, and they didn't do their due diligence either, and they are getting bailed out. And maybe it may be a costless bailout in the end, but nonetheless, it reinforces this sense, I think, that the rules are different for different people.
Yeah, and this also brings up one of those phrases that was bandied about so frequently back in 2008, which is moral hazard, right? If you rescue this one cohort, does that encourage future risk taking? Do you think, when companies typically decide who to bank with, they're not looking at the balance sheet, right? They're not trying to figure out what the risk usually at that bank is. Is that just something that needs to fundamentally change?
Well, it's a really good question. I think the phrase moral hazard is very relevant here. And every time the Fed extends its safety net, you increase the moral hazard in the system. And this is an extension of the safety net. Depositors over $250,000 were not supposed to be bailed out. The question, I don't think that small investors, consumers, should have the responsibility of having to do due diligence on their bank's balance sheet. No, but should big companies, should the venture capitalists who did business with Silicon Valley Bank and encouraged their portfolio companies to do all their banking there, should they have done more due diligence? I think the answer to that is yes.
Bethany, as someone that has written on fraud in the past, I believe Enron, is there anything you are seeing in the early going regarding this situation that you would compare to that?
No, except that I do not see any signs of fraud. But I do think that this is, in the end, part of Enron was a failure of regulation. It was a failure of the regulators to keep tabs on what was actually happening. And this, to me, is the big question to me about Silicon Valley Bank. Is this was supposed to be the Fed's responsibility? Not only was Dodd-Frank supposed to address this through something called resolution authority that was supposed to be able to unwind a failing bank without having to do a bailout. That's not obviously what happened here. But the Fed itself was in charge of supervising Silicon Valley Bank. And again, the risk factors that have led to this happening seem really obvious. Hindsight is always 20/20, but they seem like they should have been obvious at the time. Really, really fast growth, which is what Silicon Valley Bank had, is a red flag at a bank. It's a sign for somebody to take a closer look. And so what worries me here is that this does seem to me to be an overarching failure of the Fed, both as a regulator. And I think that's concerning.
The other thing that kind of this reminds me of, and the sort of through line for these various crises that you've covered, is hubris, right? This view on the part of people who are doing this stuff that it can't happen to me, that this is the right path to take, right? And is the only way to clamp that down through regulation?
Well, this would argue that no, that isn't the right way, because Dodd-Frank was supposed to prevent this from ever happening again, and that didn't work out so well. So, I mean, it's Einstein, right? The definition of insanity is doing the same thing over and over again and expecting a different result. And if more regulation that was specifically designed to prevent a bank failure didn't prevent a bank failure, I'm not quite sure. Part of the problem to me seems to be that if you fail, if you're big enough to take and important enough to take a lot of things that are important to the economy down with you, then you get bailed out. And that, I was thinking about the differences between this and Enron. So when Enron went down, it went down because Enron wasn't lucky enough to take others down with it. In this case, for Silicon Valley Bank, the failure of all of these venture capital funded companies would have been devastating. It would have been a terrible cost to employees. And so I don't think that regulators had a choice but to step in. And yet the creation of this loop, whereby if you're important enough that your failure is going to do damage to the real economy and ordinary people, then the rules become different. There's something in that seems not great.
Vanity Fair contributing editor Bethany McLean, always good to get some time with you. We'll talk to you soon.
Thank you so much.